The last time we spoke, we put report season in focus, but you had said that the political risk remained a factor. We've since seen an economic survey released by Renaissance Capital emphasize that political tension and uncertainty in the country is likely to reverse economic growth that was realized in the last 2 years, saying that while their projections put growth, yes, at 4.3% this year, economic shockwaves are hard to rectify, which could, well, stagnate this progress moving forward. What's your assessment of the political situation in the country at the moment and the possible impact it could have on the market scene?
Well, I think we all got a rude shock not so long ago, and the NSE fell about 3% peak to trough and now has recovered all that back. I think the political concerns are a little bit overblown. I think the political map has been redrawn in the president's favor, and a lot of noise has come about around that redrawing of the map. I tend to think it's overblown, but the sword of Damocles that hangs over the political area is the ICC, and we're all awaiting further developments from there. I think that's the game changer for investors if Ocampo follows through.
Having said that, to what extent has this already been priced into the markets? I mean, bearing in mind that the run-up to the 2012 elections obviously adds another twist to predictions that are already out there.
That's an interesting question. I think the way that the market behaved in the last 2 weeks, when it got a little bit buffeted by the political interference, was very well behaved. We fell about 3 percentage points on the NSE 20, which is hardly high beta. And I think what that is, the signal that we're getting sent from that behavior is that the market has a great deal priced in right now. Clearly, I don't think the market has 2012 priced in any proper scenario, but near term, I think most of the political risk is already in the market.
Also providing some impetus for this market, and hard to ignore, is the private sector showing quite a bit of resilience to grow business in 2010. I mean, after these 2009 results announcement, overall, they seem pretty optimistic about their respective outlooks, don't they?
Yes, they do, and I think you're seeing quite, it was a mixed bag. You got some weak performers, but overall I think the results outperformed market expectations, and I think the tone, which is so important because confidence has a huge impact on an economy such as ours, seems to signal underlying strength and resilience, and I think that's true. And I think you're seeing a lot of the private sector look at the regional market, which is an opportunity whose time has come, I think.
Well, let's hone in on a result that was out on Friday out of East African Portland Cement. I mean, it returned 434 million shillings in pre-tax profit for the first half ended December. What did you make of those numbers? Because it was quite a turnaround from what we experienced this time last year.
Well, it was all about the yen loan. They've got this yen loan which is very large, and it tends to completely obscure what's happening in the underlying business because of the mark-to-market moves. This has now been stripped out, and I think the underlying business is actually doing extremely well. There's plenty of potential. The PE is about 4, which is hardly exacting. So I think for folk who can look at the medium term, this looks an interesting investment. Within the cement sector, of course, we saw Bambury results, which were really very stellar, notwithstanding the gain they'd booked in ARM. But that's where I think investors will be attracted to Bambury most of all in that sector.
Yeah, specifically because even though some of that yen risk has been eliminated this time round, that risk is still there. I mean, if we look at the continuing strengthening of the yen against the Kenyan shilling moving forward, and it's sustaining that strength moving forward, it could well lead to higher finance costs and then erode the company's profit once again. Or are there hedging strategies at play that the investor would have to keep in mind?
As far as I'm aware, there are no hedging strategies in place, so it's a pure yen exposure that they've got on the books. I know they've discussed it for a long time, but I think they've got to go to the Minister of Finance to gain permission. And as far as I'm aware, they have not gained permission for that, for hedging that particular risk. Once they are, then we'll see the underlying business a lot more clearly, because it really has obscured it for a very long time, as you've said.
Yep, so that and I will be keeping an eye on, of course, especially in a context where you've got the likes, as you say, of Bambury and Ati River Mining that certainly aren't resting on their laurels in terms of production capacity.
Not
Just
at all.
Very quickly before we go, Aly-Khan, we know that the agricultural sector is a space that you have been very optimistic about for a long time now, and we've heard reports saying that Kenyan agricultural stocks rose to at least 15-month highs on Friday. Of course, as the Weather Office predicts more rainfall. What's your view on the sector now moving forward?
Well, I'm incredibly bullish. It's taken a long time for the penny to drop, but if I can just throw you two metrics as, for the way to value these businesses. On a breakup value, these businesses are trading at between 10 and 15% of the breakup value of the business in terms of the share price. On a price earnings ratio, you're looking at price earnings ratios of about 6 or 7 in the tea companies, where the average price earnings ratio in India is 30. This is not rocket science. The valuations are so out of sync. What it needed was a catalyst in order for us to see outperformance. I think we got that catalyst. How it came, I don't know, but it's definitely come because we're seeing broad-based buying right across the agricultural sector. Valuations remain egregious and they have plenty of headroom, Alishia, to appreciate.